Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Always excited. And how could you not be excited when Europe is back?
That's it. Plenty going on over in Europe.
Yeah, a lot going on in Europe's share market in particular. Obviously, a lot going on in Europe more generally, but there are other more qualified podcasts to talk about that. We'll talk about the finance story playing out over there and what it means for us as investors back here in Australia. We're also going to talk about Australia's obsession, the housing market.
That's it.
And we're going to be joined by Sam Gordon from Australian Property Scout to hear the latest in markets around Australia. And then we're going to close out with Cheat Sheet, where we are going to look under the hood at the portfolio of the man who has been dubbed England's Warren Buffett.
Well, cannot wait for that. But let's get stuck into it. So, Ren, today we want to talk about Europe because, as you said, there's plenty going on in a lot of ways, but we want to focus on what's going on in the stock market and with some of the companies over there. Companies have been reporting, and the stock market is outperforming for once.
Yeah, the story since we started Equity Mates back in 2017 is that Europe is boring. It's full of slow-growing laggards, and the UK as well. There's been some truth to that in the sense that Europe is full of a lot of, I guess, more industrial stocks.
Yeah.
It just hasn't matched the appeal of the US market.
Yeah. That has changed this year as geopolitical tensions, I guess, are really upsetting the traditional order of things, and Europe is now experiencing some growth in their market in general, but there are some companies that have absolutely been shooting the lights out.
So let's go for context. The S&P 500 is actually now down for the year, down 0.3%. The Aussie market, the ASX 200, is down 0.4%, while the Stoxx 600, the European index, is up more than 10%, 10.5% for the year.
So now, seriously outperforming.
It's not the best performing market in the world. That still remains Hong Kong, which is up more than 17% in 2 months for 2025. But yeah, really impressive story playing out in Europe. So you mentioned that there's a few stocks driving this story. Probably one sector is where we want to start, which is the defense sector.
Yeah. So there's a few names here, and forgive the pronunciation, but a few names that have been absolutely ripping since January. Rheinmetall, I think is a defense manufacturer for vehicles and the like. It is up almost 90% year to date.
Do you want to guess which country it's from?
Germany.
Yeah.
Yeah. Leonardo, SPA.
Yep.
Is up about 70% year to date. Bay Systems, up about 40%. So some companies here that are rightly so, absolutely, I guess, riding the tailwind of the military upheaval that is going on over there at the moment.
Yeah, I think investors expect, European leaders have said that they need to contribute more to Europe's defence and potentially go it alone. And there's an expectation that these European defence contractors are the ones that will benefit the most. There's also others like Thales and the like that are European aerospace and defence contractors. They're definitely going to win a big share of wallet. My question is also going to be I imagine there will still be a lot of American defense contractors that win out of this as well. If the US cut off defense contractor exports to Europe,
we're in trouble. You never know though with this.
It would just be crazy.
It would be, but you never know. Anyway, That's what else has been driving it though. It's not just the defense.
No, it's been pretty broad based. I think investors a lot of investors are just rotating out of the US and into Europe, and that's just pushing up stock prices generally. But some other big high performers that people may have heard of, ThyssenKrupp. You ever been in an elevator?
Yes.
They actually started their life as a big defense player in World War One. Separate story, anyway. But yeah, they are up over 100% for the year. Iveco, they a lot of like truck parts and.
I can picture Iveco, but like I'm not a trucker, so.
Societe Generale, a big French financial institution. Just Eat Takeaway, which is
Just Eat has just been bid by a South African conglomerate called Prosus for I think $4 billion or thereabouts.
Wow.
Yeah.
4 billion euros, maybe.
Euros, yeah.
Like a number of companies have gone well. The luxury brands, some of them are up. Moncler's up more than 30%. We've had a bit of a luxury, I guess, recession in the past couple of years. So good to see luxury moving. The European beer brands, Carlsberg's up. So it's been a pretty broad-based rally. The question is, how long will it continue? There's a piece of research that I always come back to, which is that it's very rare for regions or markets to outperform decade after decade. I think it's maybe happened once or twice in the past sort of century, but generally every decade we see a different market be the top performer. And the 2010s undoubtedly was America with daylight coming in second. And a lot of people have just assumed that the 2020s will be similar, but that isn't really how stock market history is played out. So whether we rotate and we see Europe win the decade, whether it is Hong Kong that wins the decade, whether who knows what happens for the rest of this decade. This is why you want to be globally diversified. And I think really importantly, this is why we have strayed away from those all-in-one ETFs for our personal portfolios, just because like the MSCI All World Index is like 70% American at this point. Whereas the way that we set up our core portfolios is we go equal weighted across a few different ETFs, so we aren't too heavily overweight the US or Australia.
Absolutely,
yeah.
That's where this starts to come to play. Now we shouldn't say that it's been all doom and gloom for the Stoxx Europe 600, because over the last decade it's almost doubled.
Yes.
And that is with dividends reinvested up about 96% or thereabouts.
Which you wouldn't be upset about. You doubled your money in 10 years.
Yes.
But if you were in the US market, you would have more than doubled your money in the last 5 years.
Yeah. So that's that.
So look, I think on one hand, the story is European stocks are ripping. It's quite broad based because a lot of investors are just rotating to Europe and buying stocks, and that's just bidding stocks up. But there have been some particular high performers, notably the defense stocks, because of the political situation and the expectations that Europe will spend a lot more on their own collective defense. So those have been some of the winners.
Yes.
But there have certainly been losers.
There has
been no bigger loser than an American company trying to win over European buyers.
Big time. And that is Tesla. And it's not good news for Tesla in Europe, that is for sure. In their recent sales announcement, they reported that their European sales have dropped 45%, with only 9,944 units sold compared to just over 18,000 in January 2024. Now, you might think, all right, it's dropped 45%, but how is that done compared to the overall EV market in Europe? It actually is a worse picture if you look at that comparison, because there is a 34% increase in battery electric vehicle sales in Europe in the same period. So incredible decline for Tesla over in Europe.
Yeah, the market share story, which is the story that a lot of Tesla investors continue to point to. I mean, that is a huge diminishment in market share in a year. Yeah.
Well, to put some numbers to that, Ren, market share fell from 1.8% to 1%, so effectively halving their market share.
That's got to be total sales, not EV sales, surely.
Yeah, I imagine.
Like,
because EV sales is only 10%, I think, of total sales. Yeah.
The idea that Tesla had 1.8% of EV sales would have been crazy to begin with.
Yeah. Total
and look, that's part of the reason why Tesla had its second worst month ever as a listed company in February, down 28%. So, I mean, depending on what you think about Tesla, it's either a great buying opportunity or a hyped stock coming back to earth. Time will tell. I'm not going to make a call. But look, we started the episode by saying Europe is back, and I think that is the headline. And it is a reminder that global diversification pays over the long term.
That's it. Well, to keep up with all of the news headlines from markets around the world, make sure you're subscribed to our daily newsletter where we'll send you a summary of the most important headlines that we think are moving markets and that are important to you. And if you'd like to listen to those headlines, you can subscribe to Headlines by Equity Mates, our newest podcast, where you'll get those headlines delivered in less than 5 minutes. Make sure you subscribe. It'll be in your podcast player now.
All right, Bryce. Well, let's pause here. And on the other side, we're going to be talking all things Australian property market with the one and only Sam Gordon.
Welcome back to Equity Mates. We are now joined by Sam Gordon from Australian Property Scout, host of Scouting Australia and the Top 1% podcast, our local property expert to dig into where the property market is at for the quarter. Sam, welcome.
Boys, thanks for having me. Always a pleasure jumping back on.
Sam, now in these quarterly segments, we like to talk about, I guess, we like to get a market update.
Yes.
Where prices are moving, what do we need to know about?
Yep.
And I think the last quarter, it's been dominated by two words repeated from every news outlet over and over again. Rate cut, rate cut, rate cut. Will they, won't they? And then once they did it, what does it all mean?
Yes.
How closely do you watch the RBA? Like, how much were you yelling rate cut in the past few months?
It's a funny thing, mate. I didn't think it was going to come, in all honesty, just because I didn't think we were really there yet from an inflationary perspective. Obviously, from a cash flow perspective and a property market perspective, it's great for us. It puts a little bit of extra fire in the market. Sentiment starts to improve. From a cash flow perspective, every deal becomes slightly better, whether you already hold it or you're buying something new. But the biggest thing for us with rate cuts is buyer sentiment. So when it really comes into effect, we see buyer sentiment pick up almost immediately especially once that first rate cut came through. We saw it straight away.
So you've actually already seen sentiment shift?
100%. Yeah.
Okay.
It could, because I think the biggest thing is it's a realization that the hiking cycle is done, even though it hasn't been a hike for circa 18 months or so. I think it's people thinking that the easing cycle is going to start. Whether it does and how quickly or slowly it happens doesn't really matter. It's a fact that the hiking cycle's done and there's a bit of relief there. So we've had a lot of people sitting on the sidelines waiting for it. We saw pretty sort of immediate change in direction from that.
So Sam, let's set the scene. Last time we spoke, Melbourne was falling.
Yes.
Sydney was flat. Perth, Adelaide and Brisbane were absolutely ripping, all
Charging.
Up double digits.
Yeah.
Has that story changed at all?
Look, it's changed a little bit. So Sydney and Melbourne definitely still probably the most lackluster markets in the country at the moment. If we look at the numbers on those, over the quarter, down 1.4% for Sydney, down 1.8% for Melbourne. Over the annual, Sydney up 2.3%, but Melbourne down 3% overall. If you look at that and you dive into that a little bit, both of them from a quarterly perspective are actually significantly worse off than what the annual looks like. Sydney's annual at 2.3, but then the quarter down 1.4. It's obviously in that little bit of a correction phase right now. The interest rate will be interesting to see what happens with that, because the other thing with interest rates or market changes and market sentiment is that people are like, oh, well, maybe it'll kick again, so maybe I'll hold off. If they don't need to sell, they don't sell. And so I think that'll be very interesting to watch both of those markets. We're already seeing Melbourne start to bottom. Stock is definitely drying up down there as well. Days on market haven't tightened up too much yet. But yeah, they're very interesting markets to kind of watch from that front. I think Sydney's very unaffordable for what it is. It's the anomaly in the Australian housing market. But yeah, interesting to sort of unpack those two. Going on to the other three that you're talking about being Brisbane, Adelaide and Perth, which has had absolute blockbuster year-on-year growth for the last 3 to 4 years. If we look at the annual, they all still recorded double-digit growth over that period. So Brisbane up 11.2%, Perth up 19.1%, so almost 20% in that calendar year, and Adelaide up 13.1%. When you dive down into the quarterly data, that's where it does change a little bit. Brisbane up 1.3% over the quarter, Perth 1.9%, and Adelaide 2.1%. So all still decent, all still in growth. And if you annualize it over a year, you're talking kind of like that 7 to 8% per annum over that, if if those growth rates continue. And obviously things do change, but we're definitely seeing a slowdown in that market of like where they were, closer to when you're in the teens up to Perth being almost at 20%. We're definitely seeing a slowdown in growth. Not that the market's going backwards or actually stagnating, but the growth rates are definitely slowing from that perspective.
Nice. Now, we sometimes get a bit of criticism for not remembering Hobart. So I want to ask you about the smaller capital cities, Hobart, Canberra, Darwin. What's going on there?
Man, it's an interesting thing. All three are like, they are seeing a bit of a contraction of stock. Hobart's an interesting one, sitting at literally 0% over the quarter, flat. Like neither way, nothing, right?
Well, Hobart, if you want us to remember you, do something.
Well, annually they did something. They went backwards.
Okay.
So they went back 0.6%. In reality, very, very flat market, like just not doing that much. Interestingly though, from the data side, stock is starting to tighten. We're starting to see that a little bit nationally where markets are a little bit tighter, smaller cities, smaller capitals. We are seeing that start to flow through as well. The same as Canberra, same as Darwin. Doesn't overly mean that like we're going to see a huge growth rate or a huge run of growth or anything like that off the back of it. But they're all pretty much sitting very, very similar markets. They're all pretty much at that zero. I had Canberra written here as well, down 0.3% over the quarter, 0.4% over the year. So nominal, absolutely minute changes in that time frame as well. So interesting to sort of unpack across the fold there too.
So those are the capital cities.
Yeah. What
about the regions?
Regions have been a bit of a different game, and it's very isolated to where the region specifically is. We were very heavily in say areas like Rockhampton around about 3 years ago actually it would have been, and it posted across like the whole of the city last year, typically between about 20 to 30% growth last year, calendar year in that time frame as well. You're seeing areas like Mackay still with great heat and great affordability. Rockhampton's still got great affordability as well, so it looks like there is still good run in the tank there. Mackay's the same thing, still very affordable for what it is, very high incomes in there. And the other thing as well, a lot of people think, like they kind of say like mining towns or regional towns and all the rest of it. They're both like 80,000 plus people populations. Mackay in particular, the gateway to the Whitsundays, like a very livable place too, as well as having big incomes in the area as well. So I think areas like that still have a lot in the tank. If we throw another on top being Townsville, which has been a bit of a standout performer the last 2 years. Again, we probably entered around about that 2 to 3 year window again now within those markets too. It did across the board as well. You're kind of sitting the more salubrious sort of areas doing double digit growth as it is. Some of your cheap areas there doing 30% growth rate last year.
Wow.
Now providing the weather events of January not affecting the market too much in that time period. It's also a very dead period in the market, so it probably wasn't the worst month for it to happen. Providing that doesn't affect the market too much from that perspective, they're definitely going to see like a continued run of growth. It's only heating up there. Stock on market's super tight. Townsville's 200,000 people population, some huge projects, a massive army base there, and only expanding as well. So yeah, really kind of growing little economies there as well as the property markets too. That's Queensland, and there's a few others there in Queensland that are showing some really good promise as well. Regional New South Wales and Regional Vic are also like really rearing their heads as quite attractive looking opportunities too. They had a really good run of growth, or some of them had really good runs of growth in COVID. Some of them saw kind of 20 to 30% a year for over like an 18 to 24 month window. So they did have some pretty good little runs in there too. And then Regional Vic is shaping up pretty nicely. It didn't have the same sort of run that Regional New South Wales did. It had a little bit of a kick, not to the same level, but affordability is looking good. Both locations, pretty much all locations, you've got to take everything with a pinch of salt. They all carry a level of red flag in terms of if you were to throw the blanket over the whole state, it's not that every location in those states are going to perform really well, but there definitely are some that are looking, pretty attractive at the moment from both a vacancy rate perspective, an affordability perspective, and a dwindling sort of supply number as well. So there's definitely some really attractive looking options within the bunch.
So that's, I guess, a snapshot of how prices are moving.
Yes.
I guess the question is that is how they've moved. I guess the question is, how do you think they'll move from here?
Yes.
One rate cut down.
Yes.
Sentiment improving, supply is constricting in a number of areas, as you're saying. I would just off the top of my head, a combination of sentiment improving, and supply dwindling.
New government could be interesting.
It does feel like things are shaping up in some areas.
Yeah, man. I mean, the market's always a two-speed or a multi-speed market, right? It's not like the whole market works in unison. Like some people might be a little bit clouded by that because of what happened in COVID. But it's
and the media speaks about the Australian property market.
100%, 100%. But in reality, it doesn't work like that at all. And you got to drill down. I always look at LGAs, the council levels. Even in a capital city, you always want to understand from a council level and a council perspective as well. They're really, really important. But yeah, man, I think the biggest thing that'll come from the rate cut side of things is that sentiment shift. The more sentiment shift, the more people that feel confident, the more people that got a little bit extra dollars in their pocket, or that property is going to cost them that little bit less a year to hold and to put into the portfolio, and the equity release and all the rest of it. It just increases that sentiment to want to go out there and do stuff. And I think the first one's like, it's definitely put some people looking properly at it. I think if we see another like 1 to 2, even over the next 12 months, those next 1 to 2 will be very interesting to see what happens in the market. I think a lot of affordable markets, you might get home buyers been sitting on the sidelines and just start flying into it as well. And investor sentiment is driven, especially like lower level investment, like lower property portfolio investors. They are very much driven by cash flows and like a worry about it either side. Bigger portfolios don't really worry. Bigger investors don't worry about it too much because it's all just the changing of the winds. You know what I mean? It's just relevant to what's happening on the day. But in that kind of lower portfolio level, you see a lot of people, they do very much get affected by it and what they're looking to do with it as well. So I definitely think it will have an impact. It's just how much of an impact, and that'll really come down to the RBA and what they decide to do. So
Well, if people want to keep up to date, you'll be jumping on each quarter to tell us what's going on in the housing market. But if they want to hear more regularly from you, you've got the Scouting Australia podcast where you talk all things property investing. You've got the Top 1% podcast where you talk all things high performance. And if people want to speak to you and the team at Australian Property Scout, they can do that as well.
100%, man.
So, Sammy, thanks for joining us.
Boys, always a pleasure. Thank you. Thanks, Sam.
Today, we're going to reveal what's inside the legendary portfolio of the English Warren Buffett, a man who refuses to buy anything but the world's most elite companies.
Okay. Hopefully Equity Mates Media is in there. Today we are talking about Terry Smith, who runs the fund Fundsmith.
Yes.
But it's a British fund manager with £36 billion under management.
He has been referred to, as we said, as the English Warren Buffett. And that's because he first rose to prominence after the 1992 publication of his book, Accounting for Growth, which exposed the misleading accounting practices adopted by bankrupt but apparently successful firms in the 90s.
Now, he was fired by his employer for refusing to withdraw the book.
Tough.
He worked in finance, was an investment banking analyst for a long time, was particularly a financials analyst, like analysed banks. Interestingly, today he refuses to invest in banks.
Well, there you go.
So what did he learn?
Which is not quite Warren Buffett, because Buffett has a massive position in Bank of America.
Yeah. And he was a long-term holder of Wells Fargo. Yeah, not exactly the same.
No.
So let's talk about Fundsmith's performance. Its date of inception was in November 2010. So it's been going for just shy of 15 years. In that time, it's delivered 15.2% annualized returns. That compares to the MSCI All World Index that has delivered 12.3% in that time. So beating the index by what? 2.9% per year.
Yeah.
You'll take that?
Yeah. I wouldn't say it's Warren Buffett-like returns.
No.
It's outperforming, which is good.
Yeah, but these days Warren Buffett isn't even getting Warren Buffett-like returns.
Yeah, he got 25%.
True, he got 25% last year. Yeah. So here's how Fundsmith described their holdings. Quote, just a small number of high quality, resilient, global growth companies that are good value and which we intend to hold for a long time and in which we invest our own money. I guess that's how.
Yeah, that's the comparison.
That's the Warren Buffett ethos bleeding through.
Yeah.
So with that description in mind, Bryce, let's take a look at their top 20 holdings.
Alrighty, well, the biggest position, so let's just do top 5. He's got Novo Nordisk as his leading at 9.23%. Then he's got Meta at 7.6%, Microsoft at 7.42%, L'Oreal at 7%, and Stryker Corp at 5.5%. So that makes up the top 5% of his portfolio.
Well, let's just pause there. I think most people are familiar with those top 4. Novo Nordisk, the GLP-1 drugs like Ozempic, Meta and Microsoft, well known, L'Oreal, beauty and cosmetics, Stryker Corp.
Yeah.
What does Stryker Corp do?
So they produce medical devices and equipment for orthopedics, surgical and neurotechnology applications.
Okay.
Yeah.
Interesting.
And I like that because if he's comparing himself to the MSCI All World, it certainly doesn't appear in the top 10 holdings of that sort of index. So
I would imagine L'Oreal doesn't either.
no, a lot of these don't as we keep going down. Yeah, so it's good to see he's not index hugging.
Well, let's go in groups of 5. So the next 5 are LVMH, the luxury goods giant, automatic data processing, Visa, Unilever, and your favorite company.
I knew you would say that. I knew you would say that. You haven't said it yet. What is it?
Philip Morris International.
Then we've got Waters.
Well, hold on. And do you want any thoughts on any of them?
I mean, again, the only one that I don't know their automatic data, so I had to look into that. They offer human resources management software and outsourced payroll processing services.
Yeah. I think when you read around Fundsmith, like that's been one of their like Buffett style long-term holdings.
Right,
Yeah.
Okay. He's obviously got a big sort of concentration around consumers and luxury, but we'll get to that in a moment.
I think if we just pause here, if you're trying to say only buying high quality businesses, I would say the businesses that we're familiar with here, I feel like tick that box. Open debate about Novo Nordisk, and is Eli Lilly the play, all of that stuff. But Meta, Microsoft, L'Oreal, LVMH, Visa, Unilever, and like as much as we hate to admit it, like the tobacco companies have been great investments
absolutely.
as well. Especially Philip Morris International over.
It's the best performer, isn't it?
No, the company that owns Philip Morris in the US is Altria, and so like if you think about where smoking rates are high, and like you want to be the internationally exposed one.
Yeah, true, I guess. But I guess your point stands that these are all and have traditionally been long-term stable compounders that just keep performing. So to keep going down the list, there's Waters Corp. Alphabet finally makes an appearance. I was going to say Marriott International, Amadeus IT Group, and IDEX Laboratories.
Okay.
So we're starting to get into some names that are not too familiar.
Oh, Marriott is a hotel chain.
Yeah.
No, it's just, anyway.
I know that.
All right, so Waters Corp, what does it do?
They design and manufacture specialty analytical laboratory instruments and software. Bit of a theme coming out here.
Yeah, similar to IDEX.
Yeah. Well, IDEX as well create products and service for veterinary, livestock and water testing markets. Amadeus IT Group, they develop transaction processing systems for travel and tourism industry. So we're getting a lot of software here as well.
Okay, and then the final 5 to round out the top 20, Coloplast, PepsiCo, Fortinet, Procter & Gamble, and Mettler Toledo International.
Coloplast, they develop medical devices and services related to ostomy, continence, urology and wound care. Fortinet, they are in cybersecurity, and Mettler Toledo, they produce precision instruments and services, again, for laboratory, industrial and food retail applications. A lot in there around the production of equipment for specialty services, it looks like, in medicine and veterinary.
If you were to say what industry, uncorrelated to economic
macro.
Yeah. And then got pricing power, they're probably some of those companies.
Yeah.
But look, I think if we group them, technology obviously plays a big role.
Yeah.
Meta, Microsoft, Alphabet, and then some of those smaller players, Fortinet, Amadeus IT, ADP, about a third of the portfolio in technology.
Yeah.
Healthcare was a big one as well. Novo Nordisk, Stryker, Waters, IDEX, Coloplast, Mettler Toledo, about 30% of the portfolio. So between those two, we're getting close to 2/3.
Yeah.
Consumer staples, L'Oreal, Unilever, Philip Morris, that gets in consumer staples?
Yeah.
Or consumer discretionary?
Staples.
PepsiCo, Procter & Gamble. Some big food giants there, PepsiCo, Unilever and Procter & Gamble.
Yeah.
That's about 23% of the portfolio. Then rounding it out, consumer discretionary, LVMH and Marriott, and then financial services, Visa.
I'd say pretty interesting portfolio construction, not a huge weighting to any particular sector, pretty evenly split. But I think they're all some pretty big hitters in there.
Visa being financial services over technology is probably a debate as well. Like Visa's business doesn't rely on its financial services. It's not like lending or
their tech.
It's their payments rails.
Yeah.
Not a lot of UK companies.
Very true.
In fact, almost no UK companies.
I think the only one maybe is Unilever.
Unilever is British.
Nice.
Some of the other ones that we weren't as familiar with could be British as well. But notable, I think, that England's Warren Buffett, one of Warren Buffett's defining features is believing in his country's capitalism.
Yes.
Turns out that England's Warren Buffett also believes in American capitalism.
Now, if you want to not only look in a bit more detail at this portfolio of Terry Smith, but the portfolio of many other professional investors, you can do so through the 13 Fs, or you can log into Ticker, which is the platform that we use to screen companies from around the world and get access to all of this information. We'll put a link in the show notes. I believe it is free to sign up, but then there is also a paid subscription if you want access globally. There'll be information on the discount for Equity Mates listeners through that link.
Yeah, ticker.com/equitymates, or the link will be in the description or show notes. But Bryce, that does it for this week here at Equity Mates. Wherever you're watching or listening, please subscribe so you don't miss another episode. Tell a friend about it or leave us a rating or review. We'd really appreciate it. But Bryce, that'll do it for us today.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.